By the end of this video, you will know exactly how to analyze any rental property like a seasoned investor, and you'll have a step-by-step system you can use on your very first deal or your 50th. Here's something that might shock you. 83% of first-time rental property investors lose money in their first 3 years. Not because they bought in bad neighborhoods, not because they got unlucky with tenants. They lost money because they skipped the analysis phase entirely or did it wrong. They bought based on gut feeling, a real estate agent's promise, or a listing that looked pretty on Zillow. But before we get to the one metric that separates wealthy landlords from those who sell at a loss within 5 years, a number most real estate courses charge thousands to teach. Let's start with the foundation. Today, you're going to learn 3 things that will change how you look at every property from this moment forward. First, the exact numbers you need to calculate before making any offer. Second, the hidden costs that destroy most investors' returns without them even realizing it. And third, the precise cash-on-cash return threshold that tells you whether a deal is worth your time or a trap waiting to drain your bank account. Quick, if you've ever scrolled through rental listings wondering which ones would actually make money and which ones would become financial nightmares, hit the like button right now. It tells the algorithm this content is valuable and helps us reach more people who need to hear this. Let me paint a picture for you. You find a property listed at $250,000. The listing says it rents for $1,800 a month. You do some quick mental math and think, that's over $20,000 a year in rent. This must be a great deal. So you make an offer, get the property, and 6 months later you're wondering why you're actually losing $400 every single month. This is the reality for countless investors. They focus on the purchase price and the gross rent, ignoring the 15 to 20 other variables that determine whether a property builds wealth or destroys it. The average failed rental investor loses $37,000 before giving up. That's not just money down the drain. That's years of savings. That's missed opportunities. That's the difference between retiring at 60 or working until 70. And the frustrating part? Every single one of those losses was predictable. The numbers don't lie. They never did. These investors just never learned how to read them properly. But here's what nobody tells you. Rental property analysis isn't complicated. It's not reserved for finance majors or people with expensive software. It's a systematic process that anyone can learn. And once you learn it, you'll never look at real estate the same way again. The shift from hoping a property works out to knowing with mathematical certainty whether it will is the difference between amateur investors and professionals. Let's start with step 1, gathering the core numbers. Imagine you're looking at a duplex in a Midwest suburb. Before you even think about making an offer, you need 7 specific numbers. Purchase price, which you can find on the listing. Estimated monthly rent, which you can verify on Rentometer or Zillow rental estimates. Property taxes, available on the county assessor's website. Insurance estimate, which you can get by calling any insurance broker for a free quote. Expected down payment, typically 20 to 25% for investment properties. Current interest rates for investment loans, usually about 0.5% to 1% higher than primary residence rates, and estimated repairs or renovations needed, which requires a property inspection or a walkthrough. Here's where most people get this wrong. They use the listing's claimed rental amount without verification. I've seen listings claim a property rents for $2,000 a month when comparable units in the same zip code go for $1,600. That $400 difference means nearly $5,000 a year in overestimated income. The actionable fix takes 5 minutes. Go to Rentometer, enter the address, and see what similar properties actually rent for within a half-mile radius. Trust market data over listing promises every single time. Step 2 is calculating your true operating expenses, and this is where deals die. Most investors dramatically underestimate expenses. They account for the mortgage, maybe property taxes, and call it a day. Reality is far more complex. Your operating expenses include property management, typically 8 to 10% of monthly rent, even if you self-manage, because your time has value. You need to budget for maintenance and repairs at roughly 1% of the property value annually. Vacancy allowance should be 5 to 8% of annual rent, because no property stays occupied every single day of every year. Capital expenditures, meaning big-ticket replacements like roofs, furnaces, and water heaters, should be budgeted at another 5 to 10% of rent. Landlord insurance runs about 20 to 30% higher than standard homeowners' policies. And don't forget lawn care, snow removal, and potential HOA fees. Let's use real numbers. On that $1,800 per month rental, your expenses look like this. Property management at 10% is $180. Maintenance reserve at that 1% annually breaks down to roughly $208 monthly. Vacancy allowance at 5% is $90. Capital expenditure reserve at 5% is another $90. Insurance at around $150 monthly. Property taxes vary, but let's say $250 monthly. That's $968 in expenses before you've even made a mortgage payment. Stop. Before I continue, this next part is critical. Most investors calculate something called net operating income by subtracting operating expenses from gross rent. So $1,800 minus $968 equals $832 NOI. This number matters enormously for the next step. Step 3 is determining your actual cash flow. Cash flow is what remains after all expenses and your mortgage payment. Using our example, let's say your mortgage payment on a $200,000 loan at 7% interest over 30 years is approximately $1,330 monthly. Your calculation becomes gross rent of $1,800 minus operating expenses of $968 minus mortgage payment of $1,330. That equals negative $498. This property loses nearly $500 every single month. Yet looking at the listing, it seemed like a great deal. This is exactly why proper analysis matters. The mistake 80% of people make is forgetting to include all the reserves. They think, I won't have vacancies, I can do repairs myself, I don't need a property manager. Then reality hits. The furnace dies in February, the tenant moves out in November, and suddenly they're scrambling for cash. The fix is simple. Always run your numbers, assuming you'll need every reserve. If the deal only works when everything goes perfectly, it's not a deal. It's a gamble. This next section changed everything for me. Step 4 is calculating cash on cash return, the king of rental metrics. Cash on cash return tells you what percentage you're earning annually on the actual cash you invested. Here's the formula: annual cash flow divided by total cash invested, multiplied by 100. Let's look at a property that actually works. Purchase price $200,000. Down payment of 25% equals $50,000. Closing costs of $6,000. Initial repairs of $4,000. Total cash invested equals $60,000. Now, let's say after all expenses and mortgage, you're clearing $350 monthly profit. That's $4,200 annually. 4,200 divided by 60,000 times 100 equals 7% cash on cash return. Is 7% good? In the current market, anything above 8% is solid. 10% or higher is excellent. Below 6%, you can probably do better in index funds with zero landlord headaches. But remember, this doesn't account for appreciation, principal paydown, or tax benefits. Real estate builds wealth through multiple channels, but cash flow is your foundation. Step 5 is the often ignored debt service coverage ratio, or DSCR. If you've made it this far, you're already ahead of 95% of people, and what I'm about to share in this next section is the most valuable part of this entire video. Don't skip it. Subscribe to @WealthDecode Plus if you haven't already. We drop a brand new money strategy every single day at 6 p.m. Hit that notification bell so you never miss one. Banks use DSCR to determine if they'll lend to you. You should use it to determine if a property can survive tough times. The formula is net operating income divided by annual debt service, meaning total mortgage payments for the year. Using our first example, NOI of 832 times 12 equals 9,984 annually. Annual mortgage payments equal 15,960. DSCR equals 9,984 divided by 15,960, which is 0.63. Anything below 1 means the property doesn't generate enough income to cover its debt. You want a minimum of 1.2. Most lenders require 1.25 for investment property loans. Our first example fails this test miserably, confirming what the cash flow analysis already told us. I need to pause here, because this is where most people go wrong. Step 6 involves analyzing the market fundamentals beyond just the property. A great deal in a dying market is still a bad investment. You need to check population trends, asking whether people are moving to or away from this area. Look at job diversity to see if the local economy is dependent on one employer or industry. Research median income trends to determine if wages are rising or stagnant. Examine rent growth history over the past 5 years to see how much rents have increased. And investigate future development to learn what's being built nearby. Here's a concrete example. Detroit, in 2010, had properties selling for $20,000 that rented for $800 monthly. On paper, incredible returns. In reality, population was fleeing, property values continued dropping, and finding quality tenants became nearly impossible. Compare that to Austin, Texas in 2015. Higher entry prices but population growing 4% annually, major tech employers arriving, and rents climbing 8% yearly. Investors who paid more per property made dramatically more money. The mistake here is analyzing properties in isolation. The fix is to spend 30 minutes researching local market fundamentals before running any property numbers. Step 7 is stress testing your investment. What happens when things go wrong? Because they will. Run your numbers with these scenarios. What if vacancy runs at 15% instead of 5%? What if you get a nightmare tenant requiring eviction, costing $3,000 to $5,000 in legal fees? What if interest rates rise and you have an adjustable mortgage? What if a major repair hits like a roof for $8,000 or HVAC for $6,000? A property that works perfectly under ideal conditions but crumbles under stress isn't a good investment. It's a ticking time bomb. Most people skip this step entirely. They're so excited about a deal that they don't want to think about problems. Professionals know that the best time to plan for problems is before you own them. Do this by creating a spreadsheet with 3 columns labeled Best Case, Likely Case, and Worst Case. If worst case still keeps you above water, you have a resilient investment. Now, let's talk about practical application. What do you do today? Here's your action plan. Today, in under 10 minutes, download the free BiggerPockets rental property calculator or create a simple spreadsheet with all the formulas we discussed. Input one property you've been curious about. Don't buy anything, just practice the analysis. This week, analyze 5 properties in your target market. You'll start seeing patterns. You'll notice which neighborhoods work and which don't. You'll get faster at spotting bad deals immediately. This month, build your analysis system. Create a saved search on Zillow or Redfin with your criteria. Set up a rentometer account. Bookmark your county's tax assessor site. Get insurance quotes for sample properties so you have baseline numbers. The free tools you need are Rentometer for rent estimates, BiggerPockets calculators for full analysis, Zillow for property research, and your county assessor website for accurate tax information. Within 30 days of consistent practice, you'll be able to analyze a property in under 15 minutes with over 90% accuracy. That skill alone separates successful investors from those who lose their savings. Now remember at the beginning when I mentioned the one metric that separates wealthy landlords from those who sell at a loss? Here it is. The investors who build real wealth don't just calculate cash-on-cash return. They calculate return on equity every single year and make decisions based on whether their money is working as hard as it could be. As your property appreciates and you pay down the mortgage, your equity grows. But if that equity isn't generating strong returns, it might be time to refinance and reinvest, or sell and move into better deals. Wealthy investors review this annually. Average investors never think about it. Here's what you learned today. First, gather all 7 core numbers before analyzing any property and verify rental estimates through market data rather than listing claims. Second, calculate true operating expenses, including every reserve, because properties that only work under perfect conditions aren't investments but gambles. Third, target a minimum 8% cash-on-cash return with a DSCR above 1.2, and always stress test your numbers against worst-case scenarios. Comment below and tell me which of these 7 steps are you going to implement first. I read every single comment and I'll personally reply to as many as I can. Your answer helps me create better content for exactly what you need. In tomorrow's video, I'm revealing how to find off-market rental properties that never hit Zillow, something that took me years to figure out, and most people never learn. Subscribe right now so you don't miss it.